The story that I'm about to present is just that, a story. It's fiction, but based off of current events, real economic trends, and a war that has been brewing between the United States and China, primarily because China has combined so many countries around the world, the BRICS nations, to come against the United States dollar. It may be true. And the question you need to ask yourself is, if something like this really did play out on the streets of Wall Street, are you ready? Are you prepared? It's more of a story, unlike storing up a bunch of gold and silver because it may rise in value. But are you ready to be able to take advantage of something that may have already started and may be very hard to stop? Before we begin, I need to say this clearly. What you're about to hear is a fictional story. None of it has happened. But as you listen, you may find yourself thinking, this feels very possible. And that's the point. Because sometimes fiction reveals truths that headlines haven't caught up to yet. Let's begin. It started quietly. For months, trade tensions between the United States and China escalated. Tariffs went up, sanctions followed, restrictions tightened, technology bans, rare earth threats, currency accusations. Both sides insisted they were strong. Both sides insisted they would win. The markets ignored it. Stocks stayed elevated. AI stocks surged. Retail investors kept buying dips. Analysts repeated the phrase resilient consumer. But behind the scenes, something was shifting. Chinese financial officials, frustrated after months of tariff escalations, decided to retaliate in a way few expected. Instead of directly attacking U.S. exports, they attacked perception. On a Monday morning, major Chinese exchanges began aggressively bidding up gold and silver futures. State-backed institutions increased precious metals purchases. Financial media inside China amplified the narrative. The era of dollar dominance is ending. Gold surged, silver followed. Headlines exploded across global markets. Western analysts first dismissed it as a speculative squeeze. But then something strange happened. Chinese state media began broadcasting segments questioning the stability of U.S. debt markets. Influencers across social media platforms, some real, some automated, started amplifying messages. The dollar is weakening. U.S. debt is unsustainable. Gold is protection. It wasn't an outright attack. It was psychological pressure. Meanwhile, precious metals ETFs saw unusual volume spikes. Retail investors in the United States began noticing gold moving rapidly higher. Financial commentators debated whether this was the beginning of a currency realignment. Washington responded. Then President Donald Trump went on national television. He called the moves currency manipulation by another name. He accused China of economic warfare. And within days, tariffs were raised again, higher than before. China responded immediately. More gold buying, more silver buying, more messaging. The metals market became volatile. Prices whipsawed higher. Investors who had ignored metals for years suddenly rushed in. Fear trades accelerated. Then something even more subtle began to unfold. Foreign buyers of U.S. Treasuries quietly stepped back. Yields began creeping upward. At first, it was manageable. Then corporate borrowing costs started rising. Private equity firms, already stressed from higher interest rates, found refinancing more expensive. Leveraged companies struggled to roll debt. Earnings guidance softened. Stock market momentum stalled. The major indexes didn't crash immediately. They hesitated. And hesitation in an overvalued market can be dangerous. Then came the week that changed everything. A major regional bank announced unexpected losses tied to commercial real estate and bond portfolio write-downs. Social media amplified the headline instantly. Depositors panicked. Lines formed outside branches. Within 48 hours, the story spread. If one bank has trouble, who's next? The stock market reacted violently. Financial stocks sold off hard. Margin calls began rippling through hedge funds. Precious metals spiked again. The narrative had shifted from trade war to currency fear to banking instability. President Trump announced emergency measures, additional tariffs, national security reviews, emergency economic meetings. But markets don't wait for press conferences. Investors began selling stocks aggressively. Retirement accounts shrank. Tech stocks that once seemed invincible dropped 20% in days, then 30%. Liquidity dried up. Banks tightened lending overnight. The Federal Reserve stepped in with emergency liquidity programs, but confidence had already cracked. The dollar, once seen as untouchable, began experiencing sharp volatility, not collapse, but instability. And instability is enough to trigger fear. News anchors debated whether this was a temporary dislocation or something larger. Private equity firms halted redemptions. Commercial real estate valuations plunged further. Unemployment ticked up. Within weeks, the market was down over 40% from its peak, and then came the bank run moment. Not everywhere, but enough. Depositors moved funds to perceived safer institutions. Smaller banks bled deposits. Emergency weekend meetings became normal. The government announced coordinated action. Markets stabilized briefly, then fell again. It became clear that this wasn't just about tariffs. It wasn't just about gold. It was about leverage. Years of cheap money. Years of asset inflation. Years of believing that markets only go up. And now, everything was repricing at once. Real estate fell. Stocks fell. Private company valuations collapsed. Crypto plunged. Panic dominated headlines. And then, silence. After months of volatility, the system reached exhaustion. Markets had already fallen dramatically. Weak hands were gone. Speculation had been flushed out. The government unveiled what it called a financial stability reset plan, debt restructuring programs, bank consolidations, currency coordination agreements, trade negotiations reopened. China, facing its own internal economic slowdown from global instability, stepped back from aggressive metals accumulation. Precious metals cooled. The dollar stabilized, and something remarkable happened. Opportunity returned. Homes that once seemed impossible to afford were selling at discounts. Strong companies with real cash flow were trading at half their previous valuations. Private businesses could be acquired cheaply, but only one group was positioned to act: those who had liquidity, those who had not deployed everything at the peak, those who didn't believe the phrase "cash is trash." For years they were mocked. Treasuries yield nothing. Inflation eats savings. You have to be fully invested. But when assets collapsed, cash became power. They bought stocks from forced sellers. They acquired rental properties from over-leveraged owners. They purchased small businesses from distressed operators. They didn't panic. They prepared. Within 5 years, markets recovered. New highs were eventually reached. But ownership had shifted. Those who held leverage lost control. Those who held liquidity gained it. And here is the lesson of this fictional story. Economic crises rarely begin with one dramatic event. They begin with tension, escalation, narratives, psychology, and leverage. Geopolitical stress can amplify financial fragility. Trade wars can evolve into currency narratives. Currency narratives can influence confidence, and confidence drives markets more than spreadsheets ever will. This story hasn't happened, but history tells us that similar patterns have unfolded before. Empires stretch, debt builds, confidence peaks, then stress tests the system. The takeaway isn't fear, it's positioning, diversification, liquidity, awareness. The investors who survive resets are not the ones who predict every headline. They are the ones who prepare for volatility before it arrives, because when systems reset, they transfer wealth. And the question isn't whether volatility will ever return, it's whether you'll be positioned when it does. Again, this was a fictional story, but sometimes fiction feels close enough to reality to teach us something valuable. Stay alert, stay diversified, and never forget, liquidity is optional in bull markets. but priceless in resets.